Welcome back to the deep dive. Today we're cutting through some pretty dense financial reporting to really get a handle on four big tensions shaping the markets right now. If you want to quickly understand, where risk might be hiding, how regulators are acting, and maybe why your savings aren't really growing, this is the deep dive for you.
Yeah, we're looking at a financial landscape under, well, considerable pressure. Inflation's a big part of it. Complex regulatory moves are another. So the four things that we're pulling apart today are, first, how your savings are kind of quietly shrinking because of zero real interest rates. Second, a really unusual clash over, let's say, regulatory fairness with a big insurer. Third, the early results, and frankly, they're a bit disappointing, from a major government growth fund. And finally, actually some positive news things seem to be stabilizing in the mutual finance sector.
Okay, let's dig into that first one because it hits so many people. The erosion of savings, the headline is stark. Real interest rates on deposits are pretty much zero. People hear interest rate, they see a number, but that's not the whole story, is it?
Not at all. The number that truly matters is the real interest rate. That's simply the rate the bank gives you minus the rate of inflation. And the recent reports peg consumer price inflation at 2.4%. Now, if you look at even the best one-year deposit rates out there, the ones banks are really pushing, like some regional or savings banks trying hard to pull in cash, even those top out right around 2.4%. Maybe slightly more, maybe slightly less.
So best case scenario, you hunt down the absolute highest rate you can find, and your money basically just keeps pace with rising costs. You're not gaining ground.
Pretty much. You're essentially just treading water. Your purchasing power stays flat. It's not exactly a winning investment strategy.
Right, and that's the best case. What about for most people, with money in the big commercial banks?
But for them, it's worse. The base rates, the major players, Shinhan, those guys, they're quite a bit lower, like 2.05%, 2.15%. So for millions of savers there, inflation is actively, eating away at the value of their savings every single day.
And this isn't just theoretical. We're seeing real consequences in market behavior, right? Money is moving.
Absolutely. The data is quite dramatic. Just last month, the top 5 commercial banks saw their demand deposits checking accounts basically drop by nearly 22 trillion won.
Wow, 22 trillion won in a month. That's a massive shift.
It's huge. And the crucial thing to understand for you listening is where that money is likely going. This zero real rate situation creates, well, a desperate search for yield. People, and this includes retirees who really depend on safe interest income, they feel forced to take on more risk. We're seeing folks pull out maturing deposits or even take loans against their deposits just to get capital into things like stocks, riskier assets.
Which sounds like it's just amplifying risk across the whole system. And if the Bank of Korea does cut the base rate later,
that search for yield will only get more intense. You'd likely see even more money pushed into more volatile investments.
Okay, so that pressure, that risk-taking, sets the stage for our second point, the regulator stepping in. But this case with Ladinan Life Insurance sounds complicated. The SSC, the main financial regulator, is talking about prompt corrective action, mandatory measures. But the company's numbers look fine.
That's the paradox, exactly. Profits are up quite strongly, actually, like 42% year on year. And their main solvency measure, the KICS ratio.
KICS, right. That's the Korea Insurance Capital Standard, sort of like Europe's Solvency II.
Precisely. And their KICS ratio was 141.6% as of September. The recommended minimum is 130%. So quantitatively, objectively, they look comfortably capitalized.
So why the threat of mandatory action? Where's the problem?
It boils down to the non-quantitative part of their assessment. The overall capital adequacy review is split, right? 60% is the quantitative stuff, like KICS. 40% is non-quantitative. They scored okay on the numbers, but they got a low grade, a 4th grade on the non-quantitative side. And the specific trigger cited was a delay in implementing ORSA.
ORSA, let's clarify that.
Sure. ORSA stands for Own Risk and Solvency Assessment. It's basically an internal process where the insurance company has to proactively assess its own risks, looking forward, and its ability to manage them. It's not just about current capital, but future risk management strength. Ladinan Life apparently had delays in getting this system fully up and running, and that procedural delay led to the bad non-quantitative score. That poor score dragged the overall assessment down.
So a potential mandatory action triggered not by weak finances, but by a delay in rolling out an internal assessment system. That seems significant.
It really is. And the financial industry is watching this very closely. If the FSC goes ahead, it'd be almost unprecedented, at least since 2005. It would mean a subjective judgment on a procedural issue could override strong objective financial health and trigger serious regulatory action.
You can see why that would cause concern, potential for arbitrary decisions.
That's the fear. It raises questions about proportionality. Is this punishment fitting the actual risk posed? Industry analysts worry it could open the door to regulators intervening based on procedural hiccups, even when a company is profitable and solvent. That could, damage market trust.
A real tension there between objective health and subjective regulatory judgment. Okay, let's shift gears to government-led investment. The Moon administration's Innovation Growth New Deal Fund. How's that looking?
Well, the early report card is pretty sobering. These are meant to be long-term funds, obviously. But the initial recovery rate is quite low. The fund raised about 12.8 trillion won, but so far the amount recovered from investments is only around 895 billion won. That puts the recovery rate at just 6.97%.
Oof, under 7%. Even for venture-style investments, that seems low for this stage. What's the explanation?
The VC operators involved seem to agree on the main reason: timing. Most of the investments were made in 2021 and 2022.
Right, which was peak market frothiness. Valuations were sky high then.
Exactly. They were buying assets when prices were arguably inflated. So getting profitable exits now, or even in the near future, is proving much harder and will likely take much longer than perhaps originally planned.
That's a key lesson as the current government plans its own massive fund, the 150 trillion won National Growth Fund. What warnings are coming out?
The main caution flag is being raised by NABO, the National Assembly Budget Office. They're worried about overlap. We already have several specialized government funds targeting specific sectors: AI, biotech, semiconductors, run by different ministries.
So the risk is this giant new fund just ends up throwing money at the same areas, maybe even the same companies, as the existing smaller funds. Duplication of effort.
That's the concern. NABO is stressing the need for this new mega fund to have a really clear, differentiated investment focus. They're suggesting requirements for differentiation plans and maybe a more unified management approach across government to avoid this kind of overlap and wasted capital.
Makes sense. Okay, we've covered savings pressure, regulatory clashes, and fund performance issues. Let's end on that positive note you mentioned: mutual finance institutions stabilizing.
Yeah, some good news here. After a really concerning period earlier in the year with rising delinquency rates, things have improved significantly. Take CMAL Treasury, for instance. Their delinquency rate hit a peak of 8.37% back in June. By the end of September, it was down in the 6% range.
That's a pretty sharp drop in just a few months. Credit unions, too.
Similar story. Credit unions saw their rate fall from about 8.36% down into the low 7% range over the same period. A marked improvement.
How did they manage that turnaround so quickly?
It sounds like really intensive bad debt management. CMAL actually launched a dedicated subsidiary, MGAMCO, just to tackle these non-performing loans. And at the same time, the FSS, the Financial Supervisory Service, really put the pressure on. They set aggressive cleanup targets for the credit unions and monitor them closely. So a mix of internal action and external regulatory push.
And this focus isn't easing up.
No, it seems the plan is to keep the pressure on. The supervisory authorities want to push the average delinquency rate for the main mutual finance groups even lower, down towards the 4% range. Plus, they're going ahead with a plan to increase loan loss reserves for real estate and construction loans to 130% by year-end, building bigger buffers.
So looking across all 4 points today: vanishing real returns on savings, a tricky regulatory fight over subjective versus objective measures, disappointing early returns on policy funds due to timing, and finally, stabilization in mutual finance through intense management. It paints a picture, doesn't it?
It really does. You see this dynamic everywhere. High inflation, pushing people and institutions towards risk, searching for any kind of return. And then you have regulators reacting, trying to manage that risk, sometimes with clear capital rules, other times with more subjective procedural demands that raise questions.
So we've covered the pressure on savings, regulatory disputes, policy fund performance, and mutual finance stability today.
A final thought maybe for you to consider is how this fundamental tension plays out. The desperate need for yield colliding with increasingly watchful, sometimes unpredictable regulatory oversight. Where does that balance eventually settle? That's the key question for market stability going forward.
Join us next time for more deep dives into the financial landscape. This has been The Deep Dive. Thanks for listening.